Hey guys, welcome back to the channel. So today in this video we're gonna talk about moving averages. So there are a few types of moving average. So how you can find those moving average is go to indicators and then type moving average. So the most common one is the simple moving average and the exponential moving average. So simple moving average is basically something which is quite smooth rather than the exponential moving average, which is quite reactive to the price. So let's say if I put two 50 moving averages, you see it's still different. So for the EMA, which is exponential moving average, it's quite reactive to the price and it's closer to the price. Any small movement it's more reactive, and simple moving average is more smoothen out. So why do traders use this is basically just to identify trend, looking for entries at the retracement, things like that. It's not a very prominent tool to use as a trading strategy. A lot of people just look at it as, okay, what's the overall trend? Is it trending higher, or is it towards the support? So some people use it as a dynamic support and resistance. So let's say if I were to draw out the moving average like this, so when price is coming back to the moving average, they look at it as a support. And let's say if the price is below the moving average, they look at it as a resistance. So how they will take a trade is when it breaks above and it retraces back. So when resistance becomes support at the moving average, they will take an entry and put their stop loss below, and then they will ride as the market is above the moving average, and switch the position when the market is below the moving average, something like this. Okay, so this is not like 100% strategy or things like this. This is just a basic trend filter. We look at it as trend filter. So you can use multiple EMAs, or like a crossover method. That means, let's say if I put moving average cross, MA cross. So let's say we change this to be 50 and 200. So what this 50 and 200 means is it's looking at the 50 days past prices and then averaging out. So you will be cleaning the noise of this chart. See, the chart is basically moving like this. So moving average is just smoothing everything out. So how do you take a trade based on this cross is, when the cross happens, okay, let me give you an example. So like this, when this is the fast and this is the slow. Okay, the fast is 50 and the slow is 200. So when the fast goes above the 200, this is the cross. That's when you know it's an uptrend, and then you wait for the market to retrace back. You can take a position and then you can ride the trend. Same thing for downtrend. When the fast cross below the slow, then you can take a short position. So and when you see it like this, when it's in the past, it looks very nice and clear, but most of the time you will be just bouncing and taking trades and losing money as the market just swings and crosses over. By the time you actually get a proper move, you will actually lose maybe 2 or 3 times of your money, and you lose confidence. So we don't need all that. This is just to look at it from a point of view like, okay, I want to see the overall trend. Is it really going higher and or going lower, things like that. Okay, so just use this as a confluence, where maybe you can take you can use Fibonacci, and then you can add this cross, MA cross, and you can look at it like, okay, at the 61.8%, did it cross bullish cross, then I would buy. So you are adding multiple confluences in one strategy by its own. That makes it much more better than just purely relying on one signal, for example. So let's say at this level, just give you an example, you're only looking at 32, 50 and 61% to take your entries. So at this level, you see here the market did cross above, you can take an entry here or here, you know, and then your take profit will be at the top here. So things like that. This is not like a thing. This is a lot of traders are using this as a beginner, getting into the beginning trading journey. They will use this as an pure one indicator by its own. So you can always add different, like maybe you can add a trend line strategy where you see market is going up like a channel like this, and then you want to take a trade for it to reverse. Maybe this is going an uptrend, you want to take a counter trend. So you can put in this MA cross and find for the cross somewhere around here, and you can confirm, okay, so now based on Fibonacci, based on trend line, based on this moving average, this is a very good higher probability trade that it might continue down. Market doesn't tell you like exactly this is going to go down or not. Anything can happen, but this is just giving you more confirmation and more probability sense that, okay, this might have a higher chance of dropping, things like that. Same thing for uptrend. So something like this, you will put a trend line here and trend line here, and then currently this is in the 50% area, and then you look for a cross at this area, and this can confirm to you that, okay, at this point it's rejecting 1, 2, 3 times, so I would enter a buy trade here and put my take profit at the top. And then as the market goes higher, you can do the same, put another Fibonacci and look for those zones to take more entries. So this is just one example. So I want to know what you guys use as what numbers do you guys use, because there are people who specifically use 50 and 200, some users like 30 and 90. So it depends on specific back testing, like what is best suited for your chart that you see. Like gold is quite volatile, so if you're looking at, let's say, AUD pairs is not so volatile. So and also another mistake that I see a lot of traders they do is they try to use this indicator and crossover methods in ranging market. So that's actually a no, because why is that is moving average is for trending market. It uses as a trend indicator, not for a ranging market, sideways or choppy market. We want to look for market which is showing signs of strong uptrend or downtrend. So that's where you can take entries along with the trend, because when the market is in a range, all what the moving average will show is something like this, which can confuse you, and you can take the wrong side of the trade and eventually lose money. Because at this point you'll say, oh, maybe it's a buy, then you buy, or maybe it's a sell, and then market retrace here and then flies up back, and then you will be buying at the top, and then market drops back down to the support. So you don't need all that kind of confusion. Use it in a proper trending market. So if you want to know how to look for trending market, I have a video, I'll keep it up here, that's more to how to identify trends, what to look for in a trend and all this. So Hope you guys learned something in this video. This is a short video just to explain the basics and features of the moving average. Thank you so much. Catch you in the next one.